Your money is talking to you every day, but most people don't hear it. It wants to grow without paying more taxes than it should, and that starts with the right choice between RRSP and TFSA. Today, we break down a practical approach you can use this year, even if you don't have a finance degree. We'll keep it simple, with clear steps you can follow, starting now. RRSP stands for Registered Retirement Savings Plan, and it is designed to save taxes today by letting you deduct contributions from your income. The money inside grows tax-deferred until you take it out, usually in retirement. That sounds nice, but it comes with rules. You have annual contribution room, and your withdrawals are taxed as income. The key idea is to lower your current tax bill while your money works harder over time. TFSA stands for Tax-Free Savings Account, and it doesn't give you a tax deduction up front, but any growth, dividends, and withdrawals come out tax-free at any age. TFSA is flexible for life events, emergencies, or big purchases because you can pull money without extra tax. RRSP also has flexibility through programs like the Home Buyers Plan, but it has withdrawal rules and repayment obligations. Both accounts have limits that depend on your income and the year. Your CRA notice shows your exact room. If you miss a year, the room carries forward. Use RRSP if you expect your tax rate to be higher in retirement than now. Use TFSA if you want to save without worrying about future taxes or if you want withdrawals for any purpose. Many people get an employer match through a group RRSP, which is basically free money. If your employer offers it, you should contribute enough to get the match before funding a TFSA. In the early career years, many people pay modest taxes while saving for future goals. A TFSA gives you a simple, flexible place to grow money without worrying about tax on withdrawals. After a few years, if your income climbs, RRSP can provide a bigger upfront tax shield. But remember, withdrawals are taxed, and you'll need a plan when you retire or if you need money before then. For buying a home, you can use the RRSP's Home Buyers Plan to borrow your own money tax-free for a short period. You must repay the money over time, which is an extra layer to plan for. There's also the Lifelong Learning Plan to study without cashing out your RRSP, but you have to keep track of repayment and rules. TFSA can be used to save for a house, a car, a small business, or emergencies. There are no penalties or timing rules. You can recontribute the amount later. Think of taxes as your price tag for money now and later. If your current price is higher than your future price, RRSP makes sense. Otherwise, TFSA shines. A practical approach is to use both. RRSP to reduce today's tax bill and TFSA for flexible growth and tax-free withdrawals. Let goal be to split your long-term savings into both with a deliberate plan. Step 1 is to know your numbers, your current income, tax bracket, and how much you can save each month. Check your CRA balance for RRSP room and set up a calendar reminder to review it yearly. Step 2 is to set a target split, for example, 60, 40, or 50-50, depending on your situation. Write it down and automate it so the money goes where it should without you thinking about it. Step 3 is to choose your investments, broad market index funds or low-cost ETFs that fit your risk tolerance. Keep costs low and diversify across stocks and bonds according to your age and personality. Step 4 is to automate automatic contributions from every paycheck. If your employer offers a group RRSP, enroll and set up further TFSA contributions from your own bank account. Step 5 is to treat both accounts like a single long-term portfolio. Track the overall balance and annual growth rather than obsessing about which account grows faster. One common mistake is freezing money in a TFSA and missing out on compounding in an RRSP. Another is chasing high returns. Keep a steady, boring plan and you'll win in the long run. If you start in TFSA and later move money into RRSP as your income grows, you can adjust your split. Rebalancing matters, and it's easier when you automate. As you approach retirement, you'll want to convert RRSP to RRIF or annuities while using the TFSA for taxable free income. A simple rule is to use TFSA for the extra cushion and RRSP to lower current taxes during peak earning years. Let me give a quick example. You're in your early 30s with a modest salary. You automate $600 a month to TFSA for growth and $400 to RRSP for a tax deduction. Over time, the TFSA grows tax-free while the RRSP reduces your current tax bill. Over several years, both accounts compound. When you get a raise, you can tilt more toward RRSP while maintaining TFSA contributions. If you're self-employed, TFSA gives you flexibility because there's no payroll deduction. RRSP can still work, especially if you expect lower income after retirement and want that tax shelter. Make sure you first build an emergency fund before heavy saving. Once you have that, you can start funneling money into RRSP and TFSA with a plan. Within each account, you can mix bonds, stocks, real estate funds, or cash equivalents. Keep fees low by choosing index funds and avoid trying to time markets. TFSA withdrawals are flexible. You can access money without tax or penalties. RRSP withdrawals during working years are taxed as income and can affect benefits like old age security. Remember, the Home Buyers Plan and Lifelong Learning Plan have rules and repayment obligations. If you go this route, set a repayment calendar so you don't surprise yourself in retirement. Tax planning is not about clever tricks. It's about aligning your money with your life goals. Ask yourself what you want to achieve: security, freedom, or early retirement, and let that guide the split. Here's a simple rule of thumb. Use TFSA for everything you might need before age 65, and use RRSP to soften taxes when your income is high. The right balance depends on your life, not on someone else's dream. Never treat one account as a lottery ticket. Both accounts are tools. Your life plan decides how much risk you can handle and when you'll need the money. Start small and stay consistent. Even $100 a month done every month becomes something meaningful over years. Set reminders to review your RRSP room and TFSA limit every year. Use online calculators to model different future outcomes and adjust your plan. People think RRSP is always better or TFSA is always better. The truth is, context matters, and the best path may be a blend. If you want outside help, bring your numbers and a simple plan. Ask for a blended strategy that respects your boundaries and your tax reality. Tax refunds are nice, but the real payoff is long-term compound growth. Remember, small, steady actions beat big, sporadic efforts. Make a 90-day review, reassess your situation, adjust contributions, and rebalance your investments. We've covered what RRSP and TFSA are, how they work, and a practical plan you can apply. The goal is to build a habit that fits your life, not a perfect theoretical model. If you found this helpful, hit like, subscribe, and tell me in the comments how you're planning to split your contributions this year. Let's turn this into action, not just ideas.